The S&P 500 just hit another record high. This milestone has everyone talking, from seasoned investors to those just dipping their toes into the stock market. It's a moment of excitement, but also one that brings a lot of questions and uncertainties. What does this mean for the future? How should you, as an investor, react to this news? These are the questions we aim to answer today. It's enough to make your head spin, right? The constant flux of the market can be overwhelming, especially when headlines are screaming about record highs and potential crashes. It's easy to feel lost in the noise. We see headlines about the stock market soaring, but what does it really mean for you and your hard-earned money? Are these gains sustainable, or are we on the brink of a downturn? Understanding the implications of these record highs is crucial for making informed decisions. First things first, don't panic. Market highs can be thrilling, but they can also lead to hasty decisions driven by fear or greed. It's important to stay calm and collected. It's easy to get caught up in the excitement or anxiety of market highs. The thrill of seeing your investments grow can be intoxicating, but it can also cloud your judgment. Conversely, the fear of a sudden drop can lead to rash decisions. But remember, investing is a marathon, not a sprint. The key to successful investing is patience and a long-term perspective. Short-term market fluctuations are normal, and they shouldn't derail your overall strategy. Before you make any rash decisions, let's take a deep breath and break down what's really going on. Understanding the factors driving these market highs can help you make more informed choices. We'll look at the forces driving this growth and, just as importantly, the potential risks on the horizon. Economic indicators, corporate earnings, and global events all play a role in shaping the market landscape. Knowledge is power, especially when it comes to your finances. So let's dive in. By understanding the current market conditions and the factors at play, you can better navigate the complexities of investing and make decisions that align with your financial goals. So what's fueling this incredible market rally? It's a question on everyone's mind, from seasoned investors to casual observers. The market's strength can be attributed to a combination of several key factors that have aligned perfectly to create this bullish environment. A few key factors are at play. Let's break them down to understand why the market is performing so well. First, corporate earnings have been strong. Companies are raking in profits, which is a good sign for investors. When companies report higher earnings, it often leads to increased investor confidence and higher stock prices. This cycle of positive earnings reports and rising stock prices can create a momentum that propels the market even higher. When businesses are doing well, their stock prices tend to go up. This is because investors are willing to pay more for shares of companies that are profitable and have strong growth prospects. The optimism surrounding these companies can drive the overall market upward. Second, consumers are feeling good. Low unemployment and rising wages mean people have more money to spend. Consumer confidence is a critical component of economic health. When people feel secure in their jobs and finances, they are more likely to make purchases, from everyday items to big-ticket products. That spending translates into higher sales for companies, further boosting the economy. Retailers and service providers see increased revenue, which can lead to more hiring and investment in business expansion. This creates a positive feedback loop that supports continued market growth. Finally, the Federal Reserve has kept interest rates low. This makes it cheaper for businesses to borrow money and invest in growth, which ultimately benefits the market. Low interest rates also encourage consumers to take out loans for homes, cars, and other major purchases, further stimulating economic activity. But remember, what goes up can also come down. It's crucial to be aware of potential risks. Market conditions can change rapidly, and factors such as geopolitical events, changes in monetary policy, or unexpected economic downturns can impact market performance. Staying informed and diversifying investments are key strategies for navigating the complexities of the market. While the market is looking rosy right now, there are always potential pitfalls. Inflation is a big one. Rising prices can eat into corporate profits and make consumers think twice about spending. We also need to keep an eye on geopolitical tensions. Trade wars, political instability, and global conflicts can all send shockwaves through the market. And let's not forget about economic indicators. A slowdown in economic growth or a spike in unemployment could signal trouble ahead. It's important to stay informed about these potential risks so you can make smart investment decisions. You've heard the saying, don't put all your eggs in one basket. Well, it's true for investing too. Diversification means spreading your money across different types of investments. Think stocks, bonds, real estate, and even alternative investments like gold. Why is diversification so important? Because it helps protect you from losses. If one investment takes a hit, the others can cushion the blow. Remember, a well-diversified portfolio is like a strong financial foundation. It helps you weather market storms and come out stronger on the other side. Investing in the stock market can feel like riding a roller coaster. There are ups and downs, twists and turns. But with the right strategies, you can navigate the ride and come out ahead. One strategy I love is dollar cost averaging. It's a fancy way of saying invest consistently over time. Instead of trying to time the market, which is nearly impossible, you invest a fixed amount of money at regular intervals, no matter what the market is doing. This strategy helps you buy more shares when prices are low and fewer shares when prices are high, averaging out your cost over time. Section 6. What do the experts think? Unpacking the economic crystal ball. Predicting the future of the market is like trying to read a crystal ball. It's murky at best. Economists and market analysts have different opinions about what's next for the S&P 500. Some believe the bull market will continue its upward climb, fueled by strong economic growth and corporate earnings. Others are more cautious, pointing to potential risks like inflation and geopolitical uncertainties. The truth is, no one knows for sure what the future holds. That's why it's essential to focus on what you can control, your own investment strategy. Section 7. Dollar cost averaging, your secret weapon for long-term growth. Let's talk more about dollar cost averaging. This investment strategy is often overlooked, but it can be incredibly powerful for those who are committed to long-term growth. By consistently investing a fixed amount of money at regular intervals, you can take advantage of market fluctuations in a way that can potentially enhance your returns over time. This strategy is like a secret weapon for long-term investors. Here's how it works. Instead of trying to time the market, which can be both stressful and risky, dollar cost averaging allows you to invest steadily, regardless of market conditions. This means you buy more shares when prices are low and fewer shares when prices are high, which can help smooth out the volatility of your investment portfolio. Let's say you want to invest $500 every month in an S&P 500 index fund. By setting up automatic monthly investments, you remove the emotional aspect of investing and stick to a disciplined approach. This can be particularly beneficial during times of market uncertainty or economic downturns. Some months the market might be down, and you'll be able to buy more shares at a lower price. This can be a great opportunity to accumulate more shares without having to predict when the market will hit its lowest point. Other months the market might be up, and you'll buy fewer shares at a higher price. While this might seem less advantageous, it balances out over time, as you are consistently investing regardless of market conditions. Over time, this strategy helps you average out your cost per share and potentially reduce your risk. By not putting all your money into the market at once, you mitigate the risk of investing a large sum at an inopportune time. This can be especially useful for new investors who might be wary of market volatility. Remember, investing is a marathon, not a sprint. The goal is to build wealth gradually and steadily over time. Dollar cost averaging aligns perfectly with this philosophy, allowing you to stay committed to your investment plan without getting sidetracked by short-term market movements. Dollar cost averaging is a great way to pace yourself and stay in the game for the long haul. By maintaining a consistent investment schedule, you can take advantage of the market's natural fluctuations and potentially achieve better returns over the long term. So consider incorporating dollar cost averaging into your investment strategy and watch your portfolio grow steadily over time. Section 8. Stay informed, stay ahead. The importance of market knowledge. In the world of investing, knowledge is power. The more you know about the market, the better equipped you'll be to make informed decisions. Make it a habit to stay updated on market trends, economic indicators, and company news. There are tons of resources available, from financial websites and publications to podcasts and even financial advisors. Remember, investing isn't just about picking stocks. It's about understanding the bigger picture and making strategic decisions that align with your financial goals. Section 9. The bottom line, your money, your future. The S&P 500 hitting a record high is exciting, but it's essential to approach the market with both enthusiasm and caution. Remember to diversify your investments, consider strategies like dollar cost averaging, and stay informed about potential risks. Investing is a journey, not a destination. By making smart choices today, you can pave the way for a brighter financial future. And remember, you've got this.